Favorite analogy of the party scene. Let's try and then disclose what the market is in right now. Because the last time, Madhav, I remember that we chatted, you said this party is going to go on in the till the wee hours of the morning, and we're nowhere close to an end. Now with dynamics changing, post-budget, you've seen LTCG, you've seen some redemption coming in on mutual fund inflows, crude is back at 72, and globally as well, things are looking a little toppish. And then there is always Trump's tweets that you've got to look at every morning and track them closely and try and figure out where global markets are going to head next. Where are we right now in the party then, Madhav?
Listen, to give you another analogy, sometimes you're bullish, sometimes you're bearish. Right now, I feel sort of sheepish. And on a serious note, I think that my concerns, I don't remember exactly when we spoke, but I tend to be early on trends. But one of my concerns late last year was that there were two forces that were colliding with very high valuations, and that was there's an increasing sense that there may be some trade frictions. And my other concern was that the leading group, anytime you get an acronym that is globally loved, and this time it was the FANGs, Facebook, Amazon, Netflix, and Google, just the whole tech cluster, that it just simply couldn't go wrong. When you have those combinations, then it just tells you, as we discussed, that you're at a very late stage party. And I think there have been at least speed bumps on both those issues, which is trade frictions in general, particularly with China, and the regulatory reaction to Facebook, and perhaps spilling over, and that can break what I call the trance that nothing can go wrong. And as a contrarian, those things always worry me. And I think both those big factors are unfolding, which is trade and regulation of some of the most beloved and most overowned stocks. And I don't think that's a good combination. And I think relating it to India, I think what India has in common with the US is interest rates are not going down, valuations are high, and there is no real reform momentum, and the long-term capital gains tax was obviously a negative on that. So on the other side, you've had now 2-3 months of sideways drift, maybe a 10% correction we're bouncing up from. But I don't know, my gut instinct is it's not over. There's not enough pain, there's not enough damage to the psychology, which I think is essential for a meaningful move to start. So that's my sort of best instinct and guess at this point.
Meaningful move going to come in from? Because from the February-March lows, the rebound that we've seen in the index, while we may be all joyous that from sub 10,000 levels we're back at 10,500 thereabouts, but it's been a very selective move. There's metals which have participated, IT's held out, and some of the consumption names have done very well. For the index to scale up higher from here, or overall for the markets to do well, do you think the leadership is going to remain with these pockets, or is it going to be more across the board?
I don't know. As I said, I don't think the correction is over yet. I think the path of least resistance is actually down, but I do think you could have a change in leadership towards more economically sensitive areas. And one of the indicators that I've followed for 30 years is looking at Australian mining stocks relative to Australian financial stocks. And don't ask me why, I can give you a philosophical reason, but that has always been an early warning signal of a trend change. And one of the reasons I've liked infrastructure and cement and commodities is because of that. I do think there's a trend changing. I think the PEs are as high as they're going to get, and I think the move is going to be growth related. And if it's going to be growth related, the economically sensitive areas around the world will do better, which is why Brazil and Russia and those countries have had the kind of a huge move in the last 2 years that we've seen. And I think within the sectoral area, I think you are probably seeing a transition where these stocks end up being outperforming the, whatever you want to call it, the big consumer multinationals and some of the other areas, even including the regular banking financial stocks.
Madhav, that's a great point. But typically, the way you invest is that you always look for bad news. And there is a lot of bad news now in Indian banks. Let's keep the Kotak Mahindra Bank and HDFC Bank aside for a minute. But good old PSU banks have corrected. Corporate banks, or private banks which are corporate facing in nature, they've corrected. So are you fishing in some of those old banks where right now news is bad, but maybe price is getting better?
Ideally what you want to do is you want bad news to affect the overall market and then buy the good stocks. So right now what has happened is that the stocks where the bad news really is have corrected the most. And one of the areas where sort of this kind of contrarian thinking is dangerous is in banks. Anytime something is leveraged, like Punjab National Bank, it's not enough to buy cheap value, because in a bank, cheapness can go to zero, can go to bankruptcy, which it cannot with a company that has underlying assets. So I'm willing to buy Russian mining stocks that were bombed out 2 years ago, but it has assets. I'm less willing to step up to an opaque balance sheet in a levered bank like Punjab National. So what you want to do is to see, just like you had in the financial crisis in 2008, 2009, the banks exploded and everything went down with it. And once that happens, you can buy anything. You don't have to buy the banks necessarily. The entire market's gone down. What has happened now is that the things that have gone down are selective, things that have gone up are selective, and the market net is only 5 or 6% off its high. And sort of the same thing in the US. You had a 10% correction and it's moved back up. So no, I think frankly, it's a statement to how big and powerful the up move has been in the last 2.5 years, that we're thinking of a 5% correction off the top as a big buying opportunity. So I think it's a statement on how entrenched positive public sentiment is, both in India and the US, that everybody's saying, oh, Facebook has already corrected. Isn't it a buying opportunity? India's already corrected. So I know something about that makes me queasy, especially when interest rates are rising, both here in the US, and there are trade frictions. There's a long-term capital gains tax. So I put it all and look at it, and it just makes me nervous. So I don't think we have huge downside, but I'm not sure that you've had enough of a pullback to really create fear in the system, a generalized fear in the system. You may have fear in Punjab National. Some people may be worrying about regulating Facebook or potentially, but it's not fear. So I think you need to see generalized fear and a bit of a give up, saying, I'm done. That I don't know, there's a political cycle coming in India, the credit cycle's not starting, I'm selling. We haven't seen that yet. And I think that for this market to really go meaningfully higher at 22 times earnings, you need either more fear or you need tremendous positive momentum on the economy. And I see neither at this point.